Hey investor friends, I'm Michelle Markey, and I remember a time when memes used to represent funny and popular images that were used to display funny and ironic commentary, like using Buzz Lightyear and Woody to show how there's bubbles everywhere. And now with the current activity going on with meme stocks and cryptos and housing, I kind of feel like Luke Skywalker right now in this meme, where I've only seen the raw strength of a bull market once before, and it didn't scare me enough back in 2008, but it does now. And what I'm going to talk about today is focused on some remarks that investor Jeremy Grantham recently shared in July 2021 with Reuters. And although Jeremy Grantham might be from the silent generation, he's definitely not being silent about warning about how he thinks we're in an everything bubble, and he's warning about what he thinks is an impending bust ahead. Well, no one knows what's going to happen in the future, and you should seriously question anyone who claims that they know. What we do know is you can hit that like button for the YouTube algorithm, and please subscribe, because I've got you covered in helping you and myself be the best investors we can be and be prepared no matter what happens. I greatly appreciate it. Thanks. Allow me to share some context behind where Jeremy Grantham is coming from. So I'll take us back to an article he wrote for the investment firm GMO that he published in January 2021 entitled "Waiting for the Last Dance." And in that, he wrote that the long bull market since 2009 has finally matured into a fully fledged epic bubble. And he said that this could very well be the most important event of our investing lives. And he's been studying bubbles and markets for a long time. And he's even shared more recent commentary with Bloomberg and saying that the US market should have been able to unravel at any time after January this year based on historical experiences. So I'm looking into what he suggested as some of the things to consider as we're waiting in sort of uncharted territory. And I'll talk about why we could still be in a continuing bull market and why things might begin to unravel into what might end up becoming a bear market and or a recession, which I'll explain the difference between those two. So let's consider a few more economic and market conditions and signals, like how there could be concern for the $10.5 trillion of corporate debt that's outstanding, and that could also be signaling another huge bubble, as well as how famous investor of The Big Short, Michael Burry, has been warning that we could be seeing the mother of all crashes coming, as he's projecting that meme stocks and cryptos will plummet. And then there's also what's going on with the bond market, where US Treasury bond yields have been declining. And what this might mean is that maybe people are piling into bonds, or maybe the Fed is continuing to just do its asset buying program of mortgage-backed securities and US Treasuries, and that's what's causing the US Treasury yield to go down. But what that also might signal is that people are getting worried about what could happen in the future, because if yields are going down, that means more people are buying them and the price is going up, which means that it's more expensive to seek cover in what's supposed to be the risk-free asset of bonds. But if the real inflation rate is in excess of what a bond yield can get you, then people are sort of paying for the insurance of having this safer asset, perhaps in times when maybe everything else will be falling much lower. So even if they're paying kind of negative real rates by buying a US Treasury bond, that might be more of a safe haven than other types of assets that could go down much further than this type of asset that's kind of holding steady at, even though they're pretty mediocre rates, there's certain rates that people take comfort in nonetheless. And even though from what I've read, I'm leaning on agreeing with Jeremy Grantham's sentiment, let's consider devil's advocate and the opposing argument for why the bull market, which is a financial market in which prices are expected to rise, will likely continue. And one article from MarketWatch talks about why the current bull market could continue for at least another 5 years, and they give 6 reasons why, and they include things like how there's tremendous pent-up demand, and there's an underappreciated earnings boom that lies ahead, and there's a new Fed in town, like led by Jerome Powell, and inflation won't kill the bull. and valuations will improve, and sentiment isn't extreme. So whether you agree with what the reasons are for a continuing bull market or might be worried about what might be the case for a bear market, let me also explain what could be the conditions that warrant for a bear market and how that's a little bit different from the definition of a recession, and what a recession means and how a bear market could accompany a recession. On the flip side, a bear market is considered to be a market condition where prices of securities such as stocks or commodities are declining by at least 20% or more over a sustained period of time, such as 2 months or more, and there's widespread negative investor sentiment and pessimism. So that's what a bear market is usually considered to be, and we often associate it with stock market indices like the S&P 500 or Dow Jones. So if the Dow Jones is going down for at least negative 20% for at least 2 months, then that's considered to be in a bear market. And separately, an economic recession used to be considered a decline in real GDP over at least 2 quarters, so that's at least 6 months in the calendar year. But now, according to the National Bureau of Economic Research, they consider it to mean now that a recession is a significant decline in economic activity spread across the economy, lasting more than a few months, and it's normally visible in real GDP, real income, employment, industrial production, and whole retail sales. It should make sense that we usually see a bear market in the stock market based on an economic recession unfolding, and you may be wondering, what are some of the causes of an economic recession? And I like this article by The Balance, and I borrowed from some of their top 12 items and tried to organize them. So I would actually consider the top 6 ones to be what are the likely causes of a future economic recession in the US. But there could be any number of unknown types of causes that could lead to the next recession and stock market decline. But who knows what will really be the final causes that get attributed to the bursting of the everything bubble. But some of the potential causes could include how we have loss of confidence in the economy and investments, high interest rates, a stock market crash, declining housing sales and prices, credit and liquidity crunches, asset bubbles bursting, business mismanagement, regulatory changes, deflation, wage price controls, manufacturing orders slowing down, and post-war slowdowns. And I kind of think that we're not as likely to have some of the latter items, but who knows? Nobody knows exactly what might unfold in the coming months or years. There's been so much monetary and fiscal stimulus that a lot of people in the media have been saying the US economy is red hot. So let's take stock of where we stand based on 2 factors that the Fed has as part of its dual mandate, where it's trying to make sure these 2 items are getting better in the economy to signal whether the US economy is really recovering from 2020. And the dual mandate of the Fed includes trying to get maximum employment, and this is defined as an unemployment rate of 4.5%, and to have price stability and moderate long-term rates where PCE inflation is at 2%. And as of recent figures in June 2021, we were at 5.9%, which is an increase of 0.10% from May, and that's actually not a good thing because we were on a downtrend until this June. And then as of May, we've had a small uptick going to 1.85%, and that's an increase of 0.05% from April. So based on these current economic progress indicators, we're doing okay, but the economy might not be as healthy as some of the media would have us believe. And that's why the Fed is probably just holding steady in its current policies to see how the economy might progress in the coming months. It feels like we're in a little bit of an upside down world because Jeremy Grantham has said that markets peak when people are extrapolating near perfect economic conditions into the future indefinitely. And based on the current economic progress we've had, based on the Fed's dual mandate, it doesn't look like we're at peak economic conditions, but yet it seems like markets could be peaking, but maybe they could just keep going on. And maybe some of why it's still continuing just to keep going up and up could be because based on the Shiller PE, which is around 38, there's nothing that seems to be in the way of stopping it from going to the previous dot-com peak of 44 as its Shiller PE. So who knows what that might be like, but I think that Jeremy Grantham would definitely agree with the Warren Buffett indicator or the Wilshire total stock market to GDP, which is at all-time highs of 234% of Wilshire stock market to GDP as a ratio, and that's incredibly high. That means we're at 134% higher than what Buffett would have normally considered to be a fully priced market at a threshold of 100%. And I've seen that Jeremy said that we're at levels in the stock market that's already exceeded where we were previously in the dot-com bubble. And that's also reinforced by what we see according to the Buffett indicator. Jeremy said that looking at most measures were more expensive than even in 2000, and his favorite metric to use is a price to sales ratio. And even looking back not too long ago in January 2020, before we know what'll happen the rest of the year, we were even at a higher price to sales ratio than from the dot-com bubble. And then taking a look to what's going on now, we're at a price to sales ratio of about 3.2, and this is double than what the average usually would be at about 1.6. So being that we're at double what the average should be, and I think looking at some data from before, I saw that the dot-com era was around a price to sales ratio of around 2. So we're even at least a whole point above 2. And to me, that signals that this can't be ending well, whatever might be coming. And it's a little bit scary to me that based on what a lot of respected investors are saying about what's going on in the markets, to me, it feels like I would like to take a little bit more caution than try to be too aggressive right now. Regardless what these conditions and signals may portend about the future, I've got you covered because I've got some action steps for you to consider and possibly take. And number one, I suggest that everyone has an emergency fund of at least 3 to 6 months minimum. If you can get to at least a year's worth of an emergency fund, even better. And number two, evaluate your asset allocations. Are you comfortable with what you're invested in right now? And what are your asset strengths and weaknesses? And do you consider them to be anti-fragile? Like, could they withstand some of the pressures that could be happening in certain parts of the market? So definitely think about how anti-fragile they are. And if you want to know what anti-fragile means, look up Nassim Nicholas Taleb, and he'll explain that through many of his books. And number three, are you ready for the unexpected, and do you have enough cash with which to invest? Think about if you have enough to be able to dive into the markets if there's a kind of dip that is a buying opportunity. Number four, study and calculate valuations of stocks and other assets before you buy. If Jeremy Grantham says the least overpriced are value stocks in emerging markets, what is this really suggesting about everything else? And then number five, practice different scenarios of what you would do and be honest with yourself if the markets crash 30% to 50% to 80% over many months to years, and prepare a plan and be ready. Number six, if economic and market concerns are overblown, what are the reasons that everything will just keep going up? Number seven, if there is no immediate cause for concern, perhaps we can continue simply holding and wait to see what happens. So again, like I said, nobody knows what will happen. And like Charlie Munger says, nobody knows when bubbles blow up. And so what I would leave you with is to please just keep studying and learning so that you're prepared no matter what. And if you enjoyed my video or learned something, please like and subscribe. And I wish you well on your journey to being the best investor you can be. Till next time.